Okay, good afternoon, everyone. Thank you so much for joining us today for our webinar on identifying opportunities and managing risk in a downturn. I see that few are still joining, but thank you for all of us that have joined already. My name is Gabriele Sabato. I'm the co-founder and CEO of Wiserfunding, and I will be leading this discussion today. So I know that many of you are joining from different parts of the world, different time zones, so that's great to have you. Hopefully, this is going to be an interesting discussion. Hopefully, we can keep it interactive. There will be opportunities to ask questions. There will be opportunities for me to ask questions to you. And most importantly, we hope that this is going to be relevant to all of you. We're clearly seeing something in the markets. I'm sure all of you are seeing and feeling this change. And so it's a great time to discuss it all together and a great opportunity for me to do this with you. I'm sure many of you already know Wiserfunding. Many of you are our clients. Many have looked at our solution. So it's great to have you here and have this discussion together. But despite the fact you already know Wiserfunding, as yesterday we just rebranded, let me show off a bit with all this new logo and this presentation that you're seeing here today. Wiserfunding, as you know, is specialized in processing data and providing insight, transforming this data into insights. 6 years ago, Professor Altman and myself started this company. Today, we have more than 100 clients. We serve many different geographies. But most importantly, in this slide, the number I like the most is the 3 billion. That's the amount of funds that our clients have managed to deploy in the economy to SMEs last year, thanks also to our help to assess, to better understand their counterparties. And that is really our job. That's what we like to do. This obviously gives us an amazing opportunity to speak to a lot of lenders and also feel very closely what's happening in the market. That's a bit what we're going to discuss today. And you see this first picture, I'm sure you all know, bullish or bearish. Where are you? I mean, that's the first question, really. And probably what we're going to try to see today. I mean, there's no doubt. First of all, I'm sure you all know when you're bullish, you've got great expectations for growth in the markets, where you're bearish is actually the opposite. There's no doubt. It's been almost a year now. We've seen the stock market going down. Many have been bearish in that, and it's hard to see when that is going to recover, although there are early signs. But generally, that's the first thing to get affected, and then it's almost like a tide. We've seen it for the ones of you who have been around few recessions. We've seen that tide then slowly moves into, private companies and individuals. So that's a bit what we're going to try to discuss today. Before I give you my view on that, let me ask you, and that's my first opportunity here to actually ask you a question. So it's the first poll of the day. You can all, I think, vote. And the question is very simple. Are you sensing a change in the economic cycle? That's pretty much what we're going to discuss today. So if yes, you believe actually we are already in a recession, that's the first one. If you believe we're going to enter a recession soon, that's number 2. Or if you think it's absolutely fine, you don't see any sign of a recession, that's number 3. I'm gonna let this run for a few minutes. I see we're getting there. Come on, I think you all have a feeling of what's going on. At the moment, number 2 seems to be winning by far, I would say. And I'll give you just another second there. Okay, well, let's see the results. 67% believe that yes, something is changing and we are going to enter a recession soon. But there is a good 26% that believes we are already in a recession, and only 7% thinking that everything still seems fine, which is a very interesting point. So let's look a bit of at the data. Okay, so first of all, I guess let's define what is a recession, right? So that's a period of basically negative economic growth, okay? And you all know generally a recession is defined as at least 2 negative GDP growth quarters, one after the other. Okay, so that's very important definition. I'm sure you all know that definition, but that's what we're gonna define as a recession. So despite many of you may know the definition, I don't know how many of you know that actually the euro area, so the area of the countries that have the euro currency, is already in a recession. Okay, so they've actually had already 2 consecutive quarters with negative growth. Now, massively negative. It's hard to see probably from this graph. It's just minus 0.1, but 2 consecutive negative growth quarters. So that's a sign that something is obviously happening in Europe. As usual, Europe means a lot of different countries. So there is a lot of difference there between these countries. You can see, hopefully, in this slide, that there are countries that are still growing a lot, like Poland, Luxembourg, Portugal, Croatia. I mean, they are not part of the euro area, obviously, but you know, they've been growing still very strongly. On the other side, and that's probably what is driving, you know, the euro area down, you've got Ireland, you've got Netherlands, and obviously Germany with negative growth. And that is affecting the growth of the euro area overall. But you may say, well, probably doesn't matter to me. I mean, UK is out of the euro, is out of the EU as well. So does it matter? Well, obviously it matters. You all know that the European Union remains the biggest trade partner of the UK. So how is this affecting or going to affect the UK? Well, let's say that you may have heard the Bank of England say not long ago that actually the UK is potentially going to avoid the recession, maybe just avoid the recession. I don't know. I mean, I guess that's an open question. But if you look at this graph, you can see that the last 2 quarters, actually, there was a positive growth, 0.1 positive growth, but there was a positive growth. So that means that technically, the UK is currently not in a recession. So what is really that everyone is feeling? Well, if you look at GDP, clearly, technically, the UK is not in a recession. But let's look at other indicators. What are they telling us? I mean, you all know about inflation, cost of living crisis, massive increase in cost for companies, squeezing margins. All these are things that have been around for a while. We've heard of them. Many of us have experienced this with our companies. So clearly inflation has jumped as never before, went to 11% almost, but it's down. I mean, not sure if you see, but it's been down a bit. Now we are at about 8.7. It has decreased less than the rest of Europe. So that's probably what drove a little bit of, I'd say, uncomfortable feeling. And that's why the Bank of England has recently increased again the interest rates. But still, inflation seems to have started to come down. Unemployment, well, look at this. It's almost a perfect trend, right? I mean, it's at the lowest level for many years, and 3.8, I believe. So again, these are not negative signals. So what is really happening, and why 67% of you feel that we may be approaching a recession? Because the macroeconomic indicators are not necessarily indicating that that is coming or that we are in a recession. Let me tell you what we see a bit closer now, going a bit further down. So let's leave macroeconomic indicators there. We've looked at them. They look average or even sometimes improving. But what do we see? Well, if you look at insolvencies in the UK, we are up 40% year on year. So June last year to now, it's 40% increase. If you go back 2 years, so pretty much during the COVID period, we are up 67, 65%. We all know that thanks to the government support, obviously the default rates dropped about 20, 25% during COVID. So, you know, that 65% is a bit misleading, I'd say, but still 40% increase year on year. That's a big increase in insolvencies. I think in the next slide, we're going to see the graph, and you can see how, you know, starting from the 2020, the growth here, the trend is very clear. There are a lot of companies that are really struggling, and this is increasing to levels that have been seen only during 2008, the level of insolvencies in the UK. What is driving those insolvencies? Let me go back to the previous slide. Well, payments, that's one of the major drivers. So there is a lot of pressure on cash flows, and companies are struggling to basically have enough working capital. So that's what we see as the main driver of those insolvencies at the moment. Payment uncertainty. So when we say lack of working capital, that's because the payment uncertainty has increased. What is the payment uncertainty? We'll see a slide later, but it's basically when you have issued an invoice and you're waiting to be paid, and then yourself need to pay invoices. And so these two are being delayed. 30 days are becoming 60, 90, 120. And that uncertainty on when are you going to basically receive the cash brings uncertainty on when companies can actually pay their or suppliers. That is affecting the economy. And that's a clear sign of the liquidity drying up in the system. We're seeing this consistently. And again, let me look, there is a nice slide we've put together. We track, sorry, that's not the one. This is not the one. This is the one. No, here. We track debtors and creditors. So for the one of you that don't know that, but basically creditors are the amount that a company needs to pay to their suppliers, and debtor is the amount of money, so receivables, basically the amount of money that a company needs to receive from their clients. And you can see here how, you know, obviously during COVID, there was an increase, but now it seems again a steep increase in debtors and creditors. So this is, you know, creating and adding a lot of pressure on the working capital. What generally happens, or at least what happened, you know, very recently during COVID, is when there is this type of pressure, companies tend to go to lenders, so to many of you here, and ask for, you know, some sort of facility, generally debt facility, or potentially go out and raise equity. Now, the problem here is that actually these two have become extremely hard to get. So the access to funding for SMEs is at one of the lowest levels. And you can see in this slide, basically the change. I mean, obviously we all know what happened here and why, for example, banks were lending so much into the SME world. So the orange line is bank lending to SMEs. The white line is bank lending to large corporates. And as you can see, obviously, after COVID, there's been a constant decline, about 5% year on year, every month. So that's very clear. The amount of lending has decreased. Non-bank lenders, who actually generally in this situation have an opportunity to step in and take some market share from banks, are actually struggling to raise debt facilities from the VCs, or the funds in general. And so this is actually creating, again, a lot of pressure there. There is a lot of demand from SMEs for debt and equity, but there is no offer, or very low offer at the moment. So again, liquidity extremely low. And that's even if you look at venture capital, so obviously equity. So this is what venture capital firms have been able to raise. I mean, look at the drop there. We're only 6 months into 2023, yes, but obviously you can see that's quite a significant drop in what they've been able to raise. So there may be some dry powder, as they used to say. So some funds may be holding, funds at the moment, but they're not deploying them. And so this is causing a lot of issues, and access to funding is becoming really hard. So basically, companies are being squeezed on margin, squeezed on revenues, and payment terms are becoming more uncertain. There is less liquidity. They're trying to raise liquidity. They can't find that liquidity in the market. That's how insolvency go up. Okay, so that's pretty much what we're seeing in the market. And many of you know our main tool, the SME Z-score, the output of our models. Many of you use it on a daily basis. Here, we wanted to give you an idea of what we're seeing in the market in the UK by sector. So since the start of 2022, construction has been mostly affected, really. And obviously, this part is really what we're seeing. Where you move forward here, this is just our forecast. So we expect a rebound from construction. That was the first sector to be affected, and probably potentially the one to recover sooner than the others. But then you can also see that retail and wholesale obviously is the second one, suffering quite a lot, followed by manufacturing at the moment, where the decrease manufacturing and services seem to be slightly more resilient. So that's pretty much the picture we're seeing in the market. Would love to hear more from you. And let me see if I could ask you another question here. So have you noticed an increase in the number of distressed SMEs in your portfolio recently? I mean, very curious to see that. Yes, big one, or yes, but it's really marginal, or no, your portfolio is actually looking quite resilient. So I know not all of you are lenders, so it could be, we're not going to get massive coverage here, but love to hear what you're seeing. Okay, interesting. Let me see, I'll give you another second. And all right, let's look at the results. So 69% has seen a small increase, marginal increase, which is, in line with what we're seeing. So at the moment, the tide, I think, is just about to get into the, private sector, let's say the SME world. And those insolvencies, again, are affecting companies that were already in troubles. Okay, many of these insolvency are actually the so-called zombies. For the ones of you who have followed a bit what Professor Altman has written about recently, the zombie companies, the one that actually were supposed to already be gone, but have been surviving on some sort of government help or so on. So yeah, I'm sure many of you, if not all of you, have already fantastic tools to assess the risk profile. And so probably you've managed to avoid those companies. So you're not feeling this increase that you've seen in the market in terms of insolvencies, but you're starting to see obviously something in your portfolio. There is a 13% was already seen a bit more of an increase, but interestingly, 20% hasn't seen any change, which is amazing. So well done. That's really good because, I mean, you know, the insolvencies are clearly up a lot. So if your book is showing, you know, marginal signs or no signs of distress, that's really a great result. And moving on from here, like, I guess the next point we really wanted to cover was, you know, okay, so if we are heading towards a recession and you feel that something may be happening, so what is the right thing to do? So I think that's a great question. I mean, we don't always have the right answer, but let me tell you what we're seeing most of our clients doing and what we believe to be generally common best practices. So first of all, monitor your book. I mean, that's the key. Right now, gonna be frequent changes. So changes in the quality of the borrowers in your book is gonna become more frequent. That could be anything from, you know, payment remarks, CCJs, or other things. You can see a decreasing, you know, investments in marketing, changes in their corporate structure. So there will be signs that will become more frequent. And so the monitoring piece is really important. That needs to become also more frequent from your side. So keep an eye very frequently on what's happening in the book. If you can run stress testing, that's great. I mean, you can simulate scenarios and see which one of your clients actually may be suffering sooner rather than later. There are a lot of changes you saw before in our slide by sector. Sectors are behaving differently. So obviously under stress, some companies may show more resilience than others. And so running stress testing can really help you there. Implement clear strategies in terms of watch list. So the monitoring is great, but obviously you want to transform that monitoring in actions and very often proactive action. So what can you do? You know, I remember when COVID hit, we were having the same discussion with some of our clients. So how to be proactive, offer forbearance, give a call. So if you can see in advance, if you've got a way to understand early warning signals from your book, that is also an opportunity for you to basically go and proactively offer support to your clients, which is always welcome. That increases loyalty, that reduces the risk of default. It's been proved through many crises. So that ability to be proactive, offer a payment holiday, offer a term extension, anything like that. I mean, you're seeing a large bank doing the same now for individuals, obviously in the mortgage space. That is always a great strategy. So monitoring closely and frequently your book, offering proactively forbearance is amazing. And obviously, and I'm pretty sure you've already done, reviewing your acceptance criteria, your lending criteria. I always mention this. I obviously was in NatWest Royal Bank of Scotland before starting Wiserfunding, and I remember that 80% of the losses, I mean, big numbers there, that were suffered during 2009 and 10 were actually generated by lending in the last year before the recession. So adjusting lending criteria right now is actually a key thing to do for all of you. And let me actually ask you this question. I had here ready. Let me see if I can. So maybe you've already done it or not. So have any of you already tightened your lending criteria? So maybe tighten or not. I mean, you have actually maybe relaxed your lending criteria. So be interesting. Again, I know not all of you are lenders, but would be very interesting to see if basically you have already adjusted a bit your risk appetite, or you're still very much in a wait and see mode. All right, looks like, yeah, another 10 seconds, your opportunity to share. Two are very close here. Okay, let me see. And here are the results. 57% has already taken action. I think it's you know, a good percentage, but 36 hasn't. Okay, so that's interesting. Probably wait and see, which is you know, reasonable at the moment. As I mentioned, there are very different signals in the economy, and so obviously you may want to wait and see exactly where we are heading. So great, thank you so much for sharing this. This is very, very interesting for us. So that's a bit what we think should be done. And in terms of, obviously, you all know, I mean, when we talk about monitoring portfolio, I mean, that's only possible when you've got the right data. Okay, so data is going to be key for you. Being able and understand which data is going to provide you that early warnings you need to monitor closely your book. That's going to be really a competitive advantage in the next months. Actually, I can't say few or many months because it's hard to say at this point. But obviously, we know data is fundamental, and the ability of you know, refresh data constantly is going to be key, even more important in the next months as you monitor your book. We obviously have a lot of experience there, so you may know that we provide all the type of intelligence needed in that respect. But the big news, and some of you may already know, is that we are at the moment, just today, actually, launching our new product in that space, a portfolio management product, which will help all our clients to do exactly what I'm saying. So monitor very closely your book. And that is part of the credit cycle. What we want to be always able to provide to all our clients is a coverage of the full credit cycle. So a lot of you have been using us mainly on the origination side, and now increasingly you can really take advantage of all our intelligence, our models, our data to continuously monitor your book and fully automate that part. So that's going to be absolutely key. That's an example of what is portfolio management tool. Reporting, that's going to be key. So you want to be able to set alerts, important ones, only the ones that really matter when there is a change in risk profile, and you should be aware of that. So setting alerts, setting automated refresh of your portfolio, and obviously being able to present, to extract the data and present it internally and externally. And that's the reporting. So these are some screenshots from our portfolio, the distribution of the risk, which you want to keep an eye on. How is your portfolio distributing? Is that average moving right or left? That's going to be absolutely key. But also continuously benchmarking your portfolio with the rest of the market. And so this is going to be absolutely fundamental. Our tool will give you the ability to do all this in an automated way. And so if you haven't, book a time with us. We'd be very happy to show you a demo of how this works and how can potentially help you during the next months and the next phase of the credit cycle. And talking about the credit cycle, I think I've got a surprise here because I wasn't sure if he was going to join us, but Ed, welcome.
Thank you, Gabriele. Hello, everyone. Can you hear me okay?
Yes, we can hear you well. How are you?
Well, I'm okay. Just back in New York after a long trip to Europe, and very happy to see this new product, and wish I was there in person to see the demonstration.
Thank you, Ed. Yeah, so absolutely. I mean, I've spent a few words. We've got a few questions here, but just before I open up for more questions to the audience, I just like to ask you, like, so I know you've been a bit obviously enjoying time off, a bit of holiday in Europe, but what have you seen any change in the market that has been particularly concerning lately?
Well, I think it's pretty clear that if we have a global recession, which there are many indications of that, especially in places like China, certain parts of Europe that you know very well, and increasingly in the United States, then the whole question of credit, where we are in the credit cycle, becomes even clearer. My analysis shows that there are, I would say, 3 or 4 major indicators that are showing us now that the economy in the United States in particular, the credit cycle has moved from a benign situation for the last 10 years or so into what might be called an average credit cycle in terms of default rates, recovery rates, and risk premiums required by investors. But I think this is somewhat of an illusion because the trend, particularly on default rates of risky companies like high yield bonds, leverage loans, and I'm sure small and medium-sized firms, has moved from an incredibly low level for many years of below 1% per year to this year, it's likely to be 3.5% to 4% default rates in the high yield bond area, for example. That is slightly above the historic average. But if you look at the last 4 or 5 problem cycles we've had, the default rate has always risen from a below average level to an average level. And if you are contemplating in 2024 and 2025, increasing liquidity problems to meet the refinancing needs of many companies, as well as potential recession, then I think the possibility of a stressed economic and credit cycle in 2024 and 2025 is much higher. So right now, I'd say we are in an inflection point between a benign cycle changing to an average cycle, but that average is a little not clear that it's really average. In fact, I would say that it's on the verge of moving to a stressed area. One final indicator that I look at, which I think is quite important, is, and this is particularly relevant for distressed investors, for people in the leverage finance markets, and that is the recovery rate on new defaults in 2023, where I said we should have about a 3.5% to 4% default rate, which is up considerably from the last few years. The recovery rate, that is the price of the bonds and loans at the time of default or soon thereafter, has dropped for high yield bonds to only 19 cents on the dollar. Historically, the average is 45 cents on the dollar. So we are seeing now a tremendous increase in distressed assets and defaulted assets, driving down the price of their outstanding securities, simply supply and demand. And that is a strong indicator of financial distress. This year, next year, I expect that the default rates will go up even higher. But the wild card is how bad the recession will be and whether or not inflation continues to be at a relatively high rate, which both indicators seem to point in that direction. So let me just conclude by saying that with this somewhat negative forecast about the credit cycle, it becomes so much more important, or even more important, to have a good credit risk management system, both for individual companies and, as your new product, our new product shows, in a portfolio management setting. And that portfolio management in the credit market has been long overlooked by most academics. Most academics concentrate on equity assets with respect to portfolio management. Very little work has been done, and we think that our introduction will go a long way toward increasing the knowledge about how portfolios react when you have a big downturn, as we're expecting.
Thank you. Thank you very much, Ed. That's great. And actually, a lot of what you say resonates very much with the data we were showing before for SMEs. So absolutely in line. So thank you. And, we have some questions here. So I'm just gonna take some of them. So maybe Mike, I see you're also there, so you can help me here. There is a first question from someone's asking that they already received some sort of alerts on other for other suppliers. So why would our alerts from our new portfolio management product be different from those?
Can you hear me now?
Yeah.
Can you mute that? Sorry, we're just muting on the other side. Yeah, it's a great question. Our clients have told us that they receive tons of alerts, red flag, credit safe. All of these agencies are constantly sending flags through when changes happen within companies in their portfolio. They report that they have to manually review all of these flags to decide which ones are important, which ones will affect the status of the risk profile of them companies. It's quite a manual task. Ideally, they would like to be able to personalize or customize these flags independently so they can decide for themselves which ones are red flags and which ones are just flags that are something to be noted. What we've been asked to do and what we built into our system is the fact that we will take all of these flags, we will run them through our models, and only when the risk profile changes will we send you an alert. Now, you decide how sensitive them changes are. So you may have multiple portfolios, or you might have one master portfolio, and you can change and flex how you, and that's what the next question is, so we can kind of answer that as well. You can have multiple portfolios, and if you had a watch list that you mentioned earlier on, you can decide to have a much tighter control. So the smallest change in the risk profile of a company within that portfolio, you can receive an alert. You could do it by industry, by sector, by whatever, however you want to segment that portfolio. but the alerts will be sent through either directly via a webhook within the API, or it will be via the platform, and a simple email can be sent to the underwriter to say, company A has had a change in their risk profile outside of your particular risk appetite, therefore action is needed, and we will supply you with a report to give you all of the details. Hopefully that answers that question.
Great.
The idea is to cut through the noise and give you actionable alerts rather than just giving you lots of data that you need manual people to interpret.
Absolutely, which I believe it's great, because obviously if we're going to see more changes, more frequent changes for a lot of companies, then that noise will only increase. So that's great, and I guess that's really a big help in terms of efficiency. So we discussed also about different portfolios. How do we make sure that accounting information is up to date? Well, I'll take this. Obviously, we have many different ways to do that. Our clients can upload more recent information, but the most common way, obviously, is source it directly from accounting software, and we use the most common aggregators out there, Codat and Validist. We have basically a native integration with both of them, so our clients can just relax and enjoy, and these aggregators will download at a certain frequency data directly from the accounting software, and we will be able to consume this data to refresh our monitoring. But again, financial data is only one input. You all know we use many other things that tend to change on a daily or weekly basis. Are we integrated with lending platforms? I guess, Mike, you want to mention there, so lending platform, many of you probably using different ones. We have done a lot of work.
Yeah, absolutely. We're always looking to integrate and partner with as many platforms and partners as possible. We are trying to, build an ecosystem around the SME credit life cycle. So to name a couple, we're already integrated with Encino, but we also work with people like Kennec, and you've mentioned integrations with Codat and Validist. We've got many more conversations ongoing with companies across Europe who are, various stages of that lending cycle, and where we're able to integrate. And of course, if anyone on this call has got any suggestions of people that we should be speaking to, or who you are currently using, then please let us know, because we're always looking to build out that relationship.
Great. Thanks, Mike. Paolo asking, what are the 3 main events to look after with alerts? Yeah, well, that's a great question, Paolo. I guess, there aren't really 3 main things, I would say. So this is the problem with alerts, and that's why many other providers, they send you just everything, because it's hard to say which one is relevant and which one is not. Generally, at the moment, I would say that anything to do with cash flow is quite an important signal, okay, an early warning signal. Obviously, anything legal, from a payment remark, anything that has been raised with the company legally, that's also quite a strong signal. And then again, we're seeing this increase in debtors and creditors. We monitor that very closely. Many times I hear the point, some of our clients, we have very healthy discussions about how important is commercial credit and commercial, should we consider as debt or not? I think it's extremely important. Looking at the growth in debtors and creditors account for SMEs is a strong signal of how much they're being able to recover from their client and pay to their supplier. So it's a very good indicators of health. These are just some, but obviously a lot of other elements are there, and they have different correlations with each other. So that's a bit complex, and that's why we wanted to make sure to provide alerts only when they would really impact the credit profile of a company. And well, before jumping to my favorite question that I see there, I'll just answer this other one. So do we have plans to expand coverage to countries in Eastern Europe, Greece? Well, yeah, we absolutely have. We have more than plans. We definitely have an offer. So we are integrated in 45 countries. We have full access to any type of data, financial and non-financial data, that we need to update our models, our risk metrics, our insights for origination and portfolio management. So if you are interested in any specific Eastern European country or Greece, please get in touch with us if you haven't already, because we'll be able to show you our coverage is it's very good coverage in all that area of the world. So thank you for the question. And the last, before I let you go, my favorite question. So do we use ChatGPT? I mean, you can't have any discussion today without talking about ChatGPT. So artificial intelligence, I mean, ChatGPT is part of OpenAI. We all know these guys have been extremely, let me also say fortunate. They've done a fantastic job, and they've got a massive response in the market. They've secured an incredible investment from Microsoft, and they're doing amazing things. But the reality is that the technology they use is not new. It's been around for about 20 years, one way or another. And that's the natural language processing modules, that's the deep learning. So it's all type of technology that has been around. The way they've used it offline to basically create a very powerful engine that can, understand language, can answer to question in a very advanced way. That's unique. Okay, we at Wiserfunding, we've always used natural language processing modules to basically capture unstructured data. That could be text or images, and transform it into variables that can feed into our models. Obviously, there is machine learning. We don't use machine learning to develop models, but we use it to keep the models up to date. So there are different uses of AI. Are we planning to use ChatGPT? We are exploring options there, but again, let's never forget that ChatGPT is not, at least now, real time. So there is a lag that could be, a couple of years. If you pay a bit more, can reduce slightly, but that's not real time. And for us, and for what we do, being real time data is absolutely key. So that could be other uses, and we're exploring all of these, but I don't necessarily think that for a credit assessment, that could be a direct use of ChatGPT. Great. And I guess, can we see the portfolio tool? Absolutely. Whoever is asking that one, yeah, you're more than welcome to get in touch with anyone at Wiserfunding. So myself, Mike, and our sales team, and schedule a demo. We'll be very happy to show you how it works and how it can really support everything that you are currently doing. A lot of the banks we speak to, they're still stuck with their annual reviews that employ a lot of people and a lot of resources for something that sometimes doesn't really add a lot of value. So let us show you really how we can change that, and how monitoring of a portfolio can become an incredible value to your whole business by being proactive, by being ahead of what's happening in the portfolio. So please get in touch with us. And on that note, I just want to check if Ed, any closing remark from you?
Well, I think one thing I could mention, and you've mentioned it already, Gabriele, but I must say I was a skeptic about the use of artificial intelligence to enhance credit risk models when we formed our company back in 2018. Being an old timer and used to the more traditional systems, which worked pretty well, we felt, and worked even better when we applied it to small and medium-sized firms, starting in Italy and then expanding to globally. I was a skeptic that you could add much value with these unstructured variables coming from unstructured sources like social media, company reports, etc. But I've become a true believer in the enhanced value, not a substitute for, but an enhanced value to traditional techniques using artificial intelligence and, as you may know, macroeconomic data, which changes, on a daily basis. So I'm not surprised that people are interested in ChatGPT, et cetera, to solve all their problems. But let me emphasize, it is not going to solve all your problems. It's just going to enhance techniques that already exist and add, between 5 and 15% to the accuracy of models. I had the opportunity, by the way, if anyone's interested, to ask ChatGPT, could they help us in predicting corporate defaults? The answer was, well, it's a very complicated question. And they gave very general points. I asked them about Z-score, and they said, oh, yes, Z-score is out there, very well established. We think you can enhance value, but it is a complicated question. And that's why you need really experts in the credit market to combine their skills with the ChatGPT or the, just say, AI in general information. Too often you find practitioners who are not in the credit markets, but are in, say, deep learning or artificial intelligence or machine learning. And they think that all they have to do is blindly apply these models and come up with adequate solutions. I'm convinced you really need both an experienced credit team and now the addition of modern techniques, more data retrievals, et cetera. That's about it, Gab. Hopefully that's helpful. And thank you all very much for your interest today.
Thank you. Thank you so much, Ed. And thank you for joining. Mike, anything to close from you?
No, just to, once again, thank everyone that has joined. This session has been recorded, as you can see in the top left of your screens. So we will make it available via the website and to anyone that has registered. So if you want to share it with colleagues, friends, whatever, if you have any further questions, please do reach out. We'd be happy to organize a call.
Wonderful. Thank you. Again, thank you so much, all of you, for joining today. Hopefully this has been helpful. Have a great rest of your day.